single day. I'm gonna make something great. That's my way.
Hello everyone, and welcome back to my channel. I am Ginger Wolf, and this is Stripped Finance. I am a future entertainer and stripper, not a financial consultant. So any and all information received from this channel is meant only for educational, informational, and entertainment purposes. So please, if you have any questions or concerns, take it up with your financial consultant. Now with that out of the way, let's enjoy today's video. Bye!
Hello everyone, welcome back to Stripped Finance. So, because it is still October, we're gonna stick with the spooky season. And today we're gonna do a special one. It's not really all that special, if I'm gonna tell the honest to God truth, because all of these articles are pretty short. However, when you put them together, it makes you sound like Dorothy from The Wizard of Oz. So, today we're going to do zombies, witches, and ghosts. Oh my. So today we're going to be doing 3 separate Investopedia articles that I thought y'all would like because they're cool. So the first one is going to be zombies. And no, not the ones that try to run up on you and eat your brains, okay? Even though most zombies would probably starve these days. Me. Anyways, the article is on Investopedia. It's by Will Kenton and reviewed by Amy Dury. I'm going to guess that's Dury. So, what are zombies? Zombies are companies that earn just enough money to continue operating and service debt, but are unable to pay off their debt. Such companies, given that they just scrape by, meeting overheads, wages, rent, interest payments on debt, for example, have no excess capital to invest to spur growth. Zombie companies are typically subject to higher borrowing costs and may be just one event or poor quarter performance away from insolvency or a bailout. Zombies are especially dependent on banks for financing, which is fundamentally their life support. Zombie companies are also known as the living dead or zombie stocks. Understanding zombies. Not the type that like to eat your brains, though. They just like to eat your pockets. That's it. Rawr. Anywhoosie. Zombies often fail, falling victim to high costs associated with debt or certain operations such as a research and development. They may lack the resources for capital investment, which would create growth. If a zombie company employed so many people that its failure would become a political issue, it may be deemed too big to fail, as was the case with many financial institutions during the 2008 financial crisis. Given that many analysts expect that zombies will eventually be unable to meet their financial obligations, such companies are considered riskier investments and will therefore see their share prices suppressed. Zombies were first spoken of in the reference to companies in Japan during the country's lost decade of the 1990s following the bursting of its asset price bubble. During this period, companies were dependent on bank backing to remain in operation, even though they were bloated, inefficient, or failing. Economists argue that the economy would have been better served by allowing such poorly performing companies to fail. The term zombies was picked up again in 2008 in response to the U.S. government's bailouts that were part of the Troubled Asset Relief Program, or TARP for short. While the ranks of zombie companies are small, years of loose monetary policy highlighted by the quantitative easing, high leverage, and historically low interest rates have contributed to their growth. Economists argue that such policies preserve inefficiencies while stifling productivity, growth, and innovation. When markets shift, zombies will be the first to fall victim, unable to meet their basic obligations as rising interest rates make their debt more expensive to service. Meanwhile, successful companies, which are less able to build on their success because of tight credit, may feel any downturn more than they should. While keeping zombies on life support may preserve jobs, economists note that using such resources is misguided because it impedes growth at successful firms and therefore inhibits job creation. Special considerations. Because a zombie's life expectancy tends to be highly unpredictable, zombie stocks are extremely risky and are not suitable for all investors. For example, a small biotech firm may stretch its funds extremely thin by concentrating its efforts in research and development in the hope of creating a blockbuster drug. If the drug fails, the company can go bankrupt within days of the announcement. On the other hand, if the drug is successful, the company could profit and reduce its liabilities. In most cases, however, zombie stocks are unable to overcome the financial burdens of their high burn rates, and most eventually dissolve. Given the lack of attention paid to this group, there are often interesting opportunities for investors who have a high risk tolerance and are seeking speculative opportunities. Alright guys, so that is the... My brain went dead for a minute. That is the article on zombies. I really thought that y'all would enjoy this because I was sitting there searching through it and I was like, ooh, spooky talking points. So the next we are moving on to is the witching hour. And yes, there is a witching hour in the financial realm. It is by Lucas Downey, reviewed by Charles Potters, and fact-checked by Suzanne Vilhog. I did do a video, I think a couple days ago, where the same lady had fact-checked the article, and I mispronounced her name. I actually looked it up because I was mildly curious. And much like the word knife, in the English language, the K is silent. So it's Vilhog, which is a cool name. Moving on, though. What is the witching hour? The witching hour is the last hour of trading on the third Friday of each month, when options and futures on stocks and stock indexes expire. This period often is characterized by heavy volume, such as traders close out options and futures contracts before they expire. Positions are then often reopened in contracts that expire at a later date. The witching hour is the final hour of trading before the expiration of derivative contracts. More often, traders will use the terms such as triple witching, which refers to the expiration of stock options, index options, and index futures on the same day. This event occurs on the third Friday of March, June, September, and December. When single stock futures were traded in the U.S. between 2002 and 2020, they expired on the same quarterly schedule, giving rise to the term quadruple witching. Meanwhile, double witching occurs on the third Friday of the 8 months that aren't triple witching. On double witching, the expiring contracts are options on stocks and stocks indexes. The activity that takes place during monthly witching hours can be broken down into two categories: rolling out or closing expiring contracts to avoid the expiration and purchases of the underlying assets. Due to the imbalances that can occur as these trades are being placed, pretty sure that's arbiters. I might have pronounced it wrong, but I'm pretty sure it says arbiters. Also seek opportunities resulting from price inefficiencies. The primary reason for escalated activity on the witching hour days is contracts that are not closed out may result in the purchase or sale of underlying security. For example, future contracts that are not closed require the seller to deliver the specified quantity of underlying security or commodity to the buyer of the contract. Options that are in the money, or ITM, may result in the underlying asset being exercised and assigned to the contract owner. In both cases, if the contract owner or contract writer is not in the position to pay the full value of the security to be delivered, the contract has to be closed out prior to expiration. Rolling out or rolling forward, on the other hand, is when a position in the expiring contract is closed and replaced with a contract expiring at a later date. The trader closes the expired position, settling the gain or loss, then opens a new position at the current market rate in a different contract. This process creates volume in the expiring contract and the contracts the traders are moving into. In addition to the increased volume related to the offsetting of contracts during witching hours, the last hour of trading can also result in price inefficiencies, and with it potential arbitrage opportunities due to the heavy volume coming in over a short time frame. Opportunistic traders seek imbalances in supply and demand. For example, contracts representing large short positions may be bid higher if the traders expect the contracts to be purchased to close positions prior to expiration. Under these circumstances, traders may sell contracts at temporarily high prices and then close them out prior to the end of the witching hour. Alternatively, they might buy the contracts to ride the wave up, then sell out once the buying frenzy slows down. Alright, so next, because that is the end of that article, we are going to be moving on to ghosting. So, we had a little bitty technical failure where my SD card ran out of space because I have been shooting a lot of videos. And my dummy self forgets to delete the files once I upload them. So, back to the Investopedia article. Next up is ghosting. And I'm not talking about the kind that we have all done at one point or another on the phone. I am talking about the financial term under the Laws and Regulations tab. Anywhoozy. It is an Investopedia article by Adam Hayes, reviewed by Jeffrida R. Brown, and fact-checked by Katrina Municello. What is ghosting? In finance, ghosting is an illegal practice whereby two or more market markers collectively attempt to influence a stock's price. Corrupt companies use ghosting to affect stock prices so they can profit from the price movements. This practice is illegal because the law requires market markers to compete, and ghosting is seen as a collusion. When ghosting the market, more than one firm may attempt to drive a buy or sell frenzy. Companies often initiate fraudulent activity by having several parties buy or sell large amounts of stock. This sudden increase in activity often sparks similar activities in other stockholders who are unaware of the collusion. As a result, prices rise or fall dramatically, corresponding to the buying or selling frenzy respectively. Understanding ghosting. The industry calls this ghosting because, like a spectral image or a ghost, this collusion among market markers is difficult to detect. In developed markets, the consequences of ghosting can be severe. Companies can use ghosting to either drive a stock up or down depending on the desired outcome. There are many there must be a minimum of 2 participants involved, and those included are generally conspiring together. The goal is mutually beneficial as those involved are looking to capitalize on the change in price for personal gain. Due to current laws and regulations, it is illegal for 2 firms to coordinate an event to manipulate the market. By function, market makers must be competitors, and the law requires them to act as such. Ghosting is illegal for reasons similar to those governing insider trading information because both provide investors with an unfair advantage within the marketplace. What is the difference between ghosting versus insider trading? While both ghosting and insider trading give particular firms or investors the ability to profit through illegal mechanisms, they function differently. While with ghosting, the actors manufacture a change in the market condition by the sudden increase of buying or selling of a stock. This causes the stock prices to rise or fall in response to the sudden increase in trade volume for disingenuous reasons, as no event has transpired to instigate the change. Insider trading gives those competitive firms informed of an upcoming event an unfair advantage, allowing them to buy or sell the corresponding stock before the public learns the new information. The inside information can come from company employees or any third party with the knowledge of inner workings of the organization. The recipient of this insider information is barred from using that information for gain. Alright guys, that's going to be it for this one because it is very late and I should probably try and sleep for work tomorrow. So, I'll see y'all in the next one. Bye!
Hi guys, so the effect of gravity seems to be having a really weird kind of like effect on me here. So don't forget to like, comment, share, and subscribe while I go figure this out. Bye!